ETFs are everywhere now. About a quarter of Americans own one, according to BlackRock, and the market is starting to enter a new phase. What started as a low-cost way to track the market has turned into a much more strategic tool to manage market volatility. I spoke with Christy Akulian, BlackRock head of iShares investment strategy, about how ETFs are evolving and why 2026 could be a pivotal year for the space. Looking ahead to 2026, a lot of ETF content is framed as bold predictions or buy this now. From your seat, what do you think will actually matter most for ETF investors over the next year?
When we look at where ETF assets are growing and where they're flowing, we actually see a really large demand from investors for active ETFs. So I think it's really about being nimble in these really dynamic types of environments where we're seeing the macroeconomic environment change quickly. We're seeing the geopolitical and the political environment change quickly as well. If you look at things like what types of ETFs were launched in 2025, they really came across a whole array of different strategies. What's so interesting, 83% of them were actually active ETFs. So again, more demand to just stay really nimble in these type of market environments. And we think that makes sense, particularly in some of the equity strategies that we look at, because we have seen so much of a change in leadership in terms of which equities have performed best. While we are very much believers in the AI theme, one thing that sticks out to us from the end of 2025 that we think is going to carry over to 2026 is a bit of a broadening out in terms of where we're seeing equities perform. So being nimble, being active, and being able to rotate along with markets, we think makes a lot of sense.
In other parts of the ETF market that you think investors may be overlooking, even as the industry keeps growing?
Yeah, I think that you see a lot of headlines about things like digital assets. IBIT, our Bitcoin ETF, was the fastest growing ETF of all time. But I think that's just one area where investors are really looking outside of just traditional stocks and bonds. We also saw tremendous flows, maybe a little bit more of an old-fashioned diversifier, if you think about it that way, into things like gold. So IAU, I know, had very strong performance. That's our gold ETF. But yeah, just looking outside of stocks and bonds, whether it's alternative strategies like equity market neutral or some hedge fund type strategies that are also being launched in an ETF wrapper.
And you mentioned AI. Heading into 2026, many strategists expect AI to continue shaping market returns and to remain an influence on concentration dynamics. How should ETF investors think about gaining exposure to AI without becoming overconcentrated?
Yeah, absolutely. I think it's a very big concern when we speak to every type of investor that we cover here at BlackRock. The top 10 names in the S&P 500 are about 40% of the total weight right now. That is nearly unprecedented in terms of the equity market concentration. The thing that makes us feel comfortable is that concentration is being driven by fundamentals. The price concentration is being matched by earnings concentration. So we still feel comfortable being in a lot of those AI names and sort of the AI theme. We think there's lots of different ways to invest in it. BAI is the BlackRock AI ETF that we take an active approach to. But even beyond that, we know that it's not just equities in a portfolio. It's not just U.S. equities in a portfolio. So it's about sort of diversifying within the AI theme. And looking at different parts of the supply chain, for example, looking at different regions. It's not just a US story. We like to say AI has gone global now. So looking at some of the emerging market stocks as well, and then diversifying outside of it. So again, kind of back to the not just stocks and bonds, looking at alternatives and looking at different drivers and sources of risk and return in your portfolio.
And if volatility persists into 2026, how should investors be using ETFs to manage risk and build resilience rather than just chasing performance?
Yeah, absolutely. We do always encourage people to stay invested. I think that some of the volatility means that investors, especially with a shorter timeline or a lower risk tolerance, might want to prefer moving into some lower volatility types of exposures. We think that dividend payers can be a really nice complement to AI, in that they are a little bit more value oriented. They can perform well at times when AI sells off. So just, again, thinking about ways to stay invested, but to do so in a way that fits your own investor, risk profile. So whether that's dividend payers, whether that's reaching for a little bit of value, or going more explicitly to something like a minimum volatility strategy, whatever it is that makes you feel comfortable, that lets you sleep at night, but still while staying invested to meet those long-term goals.
And with global ETF assets sitting at $19 trillion, how do you expect ETF usage to change in the next phase of growth compared with how investors used them a decade ago?
Yeah, absolutely. I mean, I think that there's two big things that have changed in ETF markets and that will continue to do so. One is kind of who uses them. So, we saw very early it was sort of a small niche, probably kind of retail product. It has grown into a tremendous tool for institutional investors, for model managers in particular. We see a lot of growth coming from there. And then second is in terms of what types of exposures ETFs allow you to get access to. So even there, we see more choice and more nuance in terms of what's being brought to markets, whether it's digital currencies, whether it's active approaches to some of the more niche parts of the fixed income market. We see a lot of growth in some of those areas. We just published a People in Money survey that we undertook. And one of the interesting things that we found is almost a quarter of all US investors own an ETF, but even more express, an indication that they're going to buy more or own ETFs for the first time going forward. So we think that there is a tremendous pipeline of potential ETF users, even in sort of the direct investor space, which has really grown a lot in recent years, and we think is going to be the source of a lot of growth to come as well.
And when you think about success for ETF investors in 2026, what does it look like beyond headline returns?
Yeah, absolutely. I mean, I think that, you don't want to just chase returns, right? You can see really strong returns in one year, and sometimes that gives up in the next year. We actually think that we're set up for pretty good returns next year. So, our base case is that we expect kind of the economy to grow. We expect the stock market to continue to go up a bit, maybe temper a little bit from the pace of the last couple years. But I think, it's not just about returns, it's about risk. So making sure that you have a diversified portfolio that doesn't move too much in one direction or other, or is not entirely driven by one factor. And then the other is really thinking in sort of the more holistic sense of not just returns that you see on paper, but after-tax returns too. I think a really skilled manager can drive investment alpha, but the right vehicle and taking the right risks in the right type of a wrapper can drive tax alpha as well. And so making sure that you take that you're holding the right vehicles and the right accounts, and really taking into account not just performance, but things like capital gains distributions as well. That's what's going to lead to long-term wealth creation, and some of the important things we think investors should probably pay even more attention to.
And last question here, as leveraged ETFs become more visible across market, sector, and single stock exposures, what concerns, if any, do you have about how they're being used, particularly with long-term investors?
Yeah, I mean, most of the way that a lot of the leverage products are set up are meant to be more short-term in nature. So you see some volatility decay. They typically have pretty high management fees. It's not really a place where we have products. But I think that the most important things for people to understand is what the time horizon is, whether they're using it as a trade or a long-term investment. And we think it's probably more appropriate for the shorter term.
As ETFs evolve beyond simple index tracking, investors are getting more selective. Active strategies, niche exposure, and risk management are starting to matter more than rock bottom fees. With assets at record levels and expectations rising, 2026 could be a defining year for ETFs. For Investors Business Daily, I'm Claire O'Connor.